I've got 9 tactics for buyers to compete in a high mortgage rate environment. Welcome to Dre's Take. All right, so this week interest rates have soared once again. They're at 23-year highs, coming in around 7.25, 7.3% or so, and it's just not all that great for buyers out there right now. Rest assured, I got to thinking, and here's 9 tactics that you can use to be more competitive or gain an edge in a high interest rate environment. Number 1, ask the seller to reduce the mortgage rate. Wait, that's possible? It absolutely is. And this would be done in the form of what's called a rate buy down. Now, you could actually have them permanently buy the rate down. That would take a lot more money and really wouldn't make all that great of a difference to your payment. But a more advantageous option, especially in a market where we're faced with 7.25% interest rates, would be to do a temporary buy down. What's better known right now as a 2-1 buy down. Some lenders offer also a 3-2-1 buy down. But to make things simple, we'll just talk about the 2-1. So with a 2-1 buy down, essentially what happens is if you're able to get the seller to contribute some money towards your closing cost, you can use those funds to prepay a portion of your interest payments for the first and second year. And by doing so, we'd reduce your fixed rate interest rate by 2% in the first year and 1% in the second year. So for example, if your rate is 7.25% fixed rate, in year 1 it would be 5.25%, year 2 it would be 6.25%, before reverting back to the 7.25% fixed rate for the remainder of the term. Now, the idea here would be that if interest rates improve by year 3, you could refinance the property into a lower interest rate and therefore a lower payment, but you'd gain the advantage of having the lower payments for the first 2 years and being able to obtain the home you want while there's less competition out in the marketplace. If you just simply wait for rates to drop, then you're going to be up against 5, 10, 15 other offers for the house that you really want. This allows you to get the property you absolutely want, take advantage of a lower payment now, refinance at a later time. Number 2 is to use part of your down payment to pay off other debt. Now, obviously, you'll have a minimum down payment requirement, 3.5% with FHA, maybe 3% with conventional or 5% with conventional. But if you had planned to use additional monies towards your down payment, say you wanted to make a higher, larger down payment, thinking that would reduce the mortgage payment itself, that may not be the best option. It may be smarter to pay off other debts, what we call bad debts, maybe high interest rate debt, credit card debts, etc. Take a bigger chunk out of your monthly budget and are just generally bad debt. By putting down a lower down payment but paying off these other debts, you may have a higher mortgage payment, but your overall monthly expenses may be lower. Number 3, use home buyer assistance programs. Every state and county has a different array of down payment assistance programs. Some of them are forgivable after so many years. Some of them only have to be repaid when you sell the property or decide to turn it into a rental or refinance. It's really up to the particular program, which are administered by the state and county level, some even at the city level. You want to work with a good agent who knows these programs and can direct you to lenders who are actually qualified to facilitate these down payment assistance programs. They're not for everybody, and they often come with income limits, meaning you can only make up to a certain amount. It's obviously there to help the folks that need it. Number 4, ask the seller to finance the purchase. You may not know this, but the seller can actually hold the mortgage, meaning they can essentially act as the lender. You make payments directly to the seller. You actually have a mortgage recorded with the county, and the seller essentially becomes the bank. Obviously, this property typically has to be paid off or owned outright by the seller in order for this to work. And they have to be willing to take the money in chunks over time instead of one big lump sum. Now, why would a seller want to do this? Well, a couple reasons. Number 1 could be they're having a tough time getting the sales price they want in the higher interest rate environment. And this allows them to structure a deal where they get the full price they want and a little bit of interest actually. So they're making a little bit more. Now they may be willing to wait to get the money because by taking the money in smaller portions over a number of years, they may lower the overall amount of tax that they pay on those profits. Number 5, don't wait for a better rate. You often hear marry the home, date the rate. A lot of folks run around saying buy now and refinance later when rates drop. But that's just a part of the equation. The real idea here is that you have less competition in this market, and if you absolutely love the home, it behooves you to act when there's less competition so you can actually get a hold of the property you really want. If rates drop later and you're able to refinance, all the better. But if rates continue to go up, you'll be happy you bought when you did and got the property that you actually wanted. Number 6, don't get distracted by things you don't need. Sellers don't like a complicated offer or a complicated deal. They don't want to have to worry about the different layers of financing and a buyer that may not be approved or a buyer that's going to nitpick every little nook and cranny of the house and ask for 1,000 repairs and a bunch of money towards closing costs. They'd rather just move on to the next buyer. And although things are a little slower than they have been in recent years, sellers still technically have a slight advantage in most scenarios, and therefore they can afford to wait for a better looking offer. This means you're going to want to focus your offer more so around the price point that works for everybody involved and forget about asking for a ton of extras and repairs and all this stuff. Make an offer that works for you based on the repairs you're willing to take on, and then make the offer clean and simple. Number 7, buy a house that needs work. Now this property may often be overlooked by most buyers, meaning you'll have an advantage when you come to the table to negotiate. You can then fix it up over time and increase the value, refinance later, pull some of that equity out if you want. There's a whole bunch of things you can do with this if you're patient enough to do so. Another option with this is to do a renovation loan. An FHA 203K is an example, where you can finance the cost of the repairs into the mortgage. The after repair value or appraised value after the repairs are done has to be in alignment with the loan amount. They're not going to give you a bunch of money over what the property's worth once it's improved. So this is for properties that are priced with repairs in mind, or you're able to negotiate the purchase price down to a level that you can include the repairs and not exceed the overall value of the property. This is another great option for folks who don't mind the work, and honestly, it's nice to be able to customize a property to your liking. Number 8, build a house or buy brand new. Now, I'm a certified new home co-broker, and I'll tell you, I absolutely love new construction. Right now, using the new construction lenders, since they do such volume and they're really incentivized to sell properties, they often offer you a better interest rate than a lot of other lenders can. They can also offer 2-1 buy downs like we spoke about before, and the builders themselves may be offering to cover closing costs or additional incentives to try to move inventory. So you can really get more bang for your buck on a brand new home, plus all the warranties and whatnot that typically come along with a new build, especially when you're working with the big nationwide builders or regional builders. Make sure you take your agent with you though. The builder's rep may not necessarily uncover all the incentives that are available to you, or they may try to put them in their back pocket to use in negotiation. An agent who knows how to work around the new construction realm can really flesh out the incentives that are available and make sure you're getting everything that's available to you. And last but not least, number 9 is rent out part of the house, also known as house hacking. You buy a home with an in-law suite, or perhaps an ADU or a duplex, triplex, etc. You live in one, you rent out the other unit or the ADU or the in-law suite, and that covers a good chunk of the mortgage, making it more affordable for you to actually own a property. Get a hold of the asset now. This is a great option and a great way to play both sides of the field here. Part homeowner, part investor. And a lot of people will tell you that buying a home is actually a liability. But when you go the house hacking route, that's not so much the case. It truly becomes an asset at that point, especially if it covers most of, if not all of, the mortgage payment. So there are 9 tips and tactics that you can use to win in a high interest rate environment. I hope you find this beneficial. I'm always happy to help if you need. Until next week, that's Dre's Take. Take care, y'all.